Get ready for the next iteration of you on your path to becoming wealthy. On this show, you'll get the insider's view on wealth creation, the class none of us got taught in school, with my co-host, daughter, and beginning investor, Sophia Bosch. And now, let's get started. Welcome to Becoming Wealthy. How are you? Thank you so much for being with us. I'm your host, Michelle Bosch. I'm here with
your co-host, Sophia Bosch.
How was school?
It was pretty good.
Are you ready to learn about cap rates and assets?
Sure, why not?
Because that's the topic for today's episode. I basically wanted to explain to you, I know not too long ago, we had here with us one of our guests that was explaining basically how large multifamily is being valued. And I know that you had a lot of questions, after that episode. And so I thought it would be a great idea to workshop basically what that all means. And before we get to an actual numbers example, I actually wanted to first ask you, how do you value currently your land?
I basically compare it to other properties that either have sold or are being sold.
Or that are being sold.
That are very similar in size, in location, in features.
Features as in like it has road access, utilities.
Or if it has a wash or something in it, things like that. And the use of the property.
Okay, makes
what you're able
sense.
To put on it, basically.
That's exactly it. Now, when we value single-family homes, we do pretty much the same that you are doing with the land. We look at how many square feet is the property, the age of the property, like when was it built, how many bedrooms, how many baths it has. Does it have a garage? Does it have a carport? And then you look at other properties, basically other homes that are in the area, kind of like you look at land that are in the close proximity, that are at about the same size, the same number of bedrooms, the same number of bathrooms. And that's pretty much how you arrive at value when you come to land and when it comes to, single family homes. And for example, if your house, if your 3-bedroom, 2-bath has the best materials on the planet, the most expensive materials on the planet, and just because it has the most expensive materials, you think that the value of that property is higher compared to others, you're right. And at the same time, you're a little mistaken in that basically you cannot value that property like excessively much higher than everything else, because the value of the property is dependent on the values of other properties similar to that one that sold, recently. And there's nothing that you can do to force the appreciation of that home. So when we talk about appreciation in real estate, we're not talking of appreciation like when we say to somebody, oh, I appreciate you so much. We're really talking about basically prices or values of properties that have gone up. That's what we refer to when we talk about appreciation.
Okay.
And so I know, Sophia.
And then depreciation.
And depreciation would be,
going down.
Prices going down. Absolutely. So now we've established how we value land. We have established how we value single family homes. But I know that you've always been, talking about valuing businesses. And I want to give you the example of a multifamily property in the form of an apartment complex, because if you think about it, and I'm going to prove this to you with numbers, it is truly a business. A multifamily property is truly a business in that you value that asset based on the net operating income.
What is that?
What is NOI? So net operating income is the rental income minus the expenses that the property has equals your net operating income. So you have gross income is what we refer to, the money that comes into the bank. Then you have all of these expenses to operate, including property taxes, including insurance, on the property, and so on and so forth. And once you deduct all of those expenses, what is left is net operating income.
Okay.
And when we value these properties, we value them based on the net operating income. We usually talk about
how much is left over.
But we usually describe net operating income as a percentage. And that percentage is called pretty much a cap rate. And so I would love to break this down for you with actual numbers. And I would love to go to the board and actually write things out and get our calculators out so that you can get a better understanding, because I think you're going to get it much, much easier if we actually have an example with numbers. Should we do that?
Sure.
Okay, let's do it. Let's go. Okay, Sophia, so let's think about an example of a property that is currently on the market right now, where they have basically priced it at $1 million. And what you're going to do is you're going to call up the broker and you're going to ask him for financial statements and pro forma statements to see what that property is spitting out in income. Remember, and we're after a specific type of income. Which one was that one?
NOI.
NOI, net operating income. Okay, so now the broker sends over the financials and you realize that that property basically is spitting out right now $100,000. Okay. So how do we find the cap rate? How can we express basically the value of this property in terms of a percentage? Because normally, in the industry, that's the terminology that brokers are going to be using when they're presenting to you a property. And so you need to be able to understand what that means. And so I want you to pull your calculator out, because how you calculate a cap rate is you are dividing the net operating income that the property is spitting out per year, this is $100,000, and divide that by $1 million. And let's see what does that come up to. This is a very simplified example because I want you to basically get the concept. But
0.1.
So it comes to 0.1, and we know, and how do we turn this into a percentage?
10%.
We move the decimal point, right? And so that means that the cap rate on this property is a 10% cap rate. That's basically the going cap rate based on the net operating income and the price that they're offering this property. Okay, let's say that we decide to buy this property because we are seeing that there's potential, because people are moving into the area, and because the property needs repairs, and because we see that the property is probably right now mismanaged and they're not charging enough rent for what the property could be charging, and we know that we could operate that property much leaner with less expenses that they're running it. And let's say that after we purchase that property, we make improvements. We're able to charge a little bit more rent. We're able to minimize certain expenses in the operations of the property. And instead, for example, of having 2 full-time maintenance people, now we only have 1, and so on and so forth. Those would be ways that we, without compromising the quality that we want to provide of housing, we can still basically reduce expenses. So let's say that a year from now, so this is year 1, right? Oops, let me turn this around. So this is year 1. And let's say that during year 2, we are able to bring that net operating income to $200,000, right? So we divided net income by price to get to value. Let's say that this property is still at a 10% cap rate. Let's pretend it is still at a 10% cap rate. Yeah. What would be the value of this property? Can you solve for this?
$2 million.
Yes. Okay. $2 million. No calculator is needed. Okay, now I think this will further clarify. So now let's say that this property now, because we're in a market where there's a lot of buyers and a lot of demand, there's an overheating in the market, and there's a lot of buyers looking for a property that is spitting about $200,000 of NOI, and because there's so much competition for a limited amount of properties, instead of them willing to get a return on their money, of 10%, they're willing to get a 5% return on their money, which is basically what the cap rate is measuring. Do you now know what does that do to the value? Because right now we went from 100 to 200, so we doubled it, and we also, here, this is 10 times, this represents 10 times a multiple of 10 times of income, this to this ratio, right? And here we basically now have doubled this. So now, but if they're now willing to take less money, basically less return on investment, for this property, because everyone is competing for the same properties, what does that do to the value of the property? Do you want to do it on a calculator?
Sure. What do I do?
So now plug in $200,000 times 0.05. I'm sorry, divided by 0.05. Okay, so now when we do this now and we divide by 0.05, what number did you arrive at?
4 million.
$4 million. So basically, when we're buying multifamily, Sophia, the whole point of buying multifamily is buying multifamily in areas where we know, that
at a high cap rate.
That are exactly. We buy high, and what are we trying to sell at a low cap rate? So this means, and I don't know if I can erase this here quickly. When the cap rate is high, the price is low.
Right.
Yeah. So when the cap rate is high, the price is low. But when the cap rate is low, the price is, because here we established that if we came to this one, that the price would go up to 4 million, right? So when the cap rate is low, the price is
high.
So there's an inverse correlation. Do you remember when we had a lady here, Anna Kelly, that was talking about basically an inverse relationship? That was the inverse relationship that she was talking about. Yeah. And what we're trying to get is basically buy a property that, that we can buy at a high cap rate, which means a low price.
Right.
And we're going to optimize it. We're going to, increase rents. We're going to get better tenants. We're going to make it better. And then ideally, we're looking at those properties, to buy those properties in areas where there's movement of people towards those areas. For example, we only invest in a few states and in a few cities where we know that this is happening. And ideally, we're then looking for, an investor that doesn't want to do all the heavy work, because usually from this price to this price, or from this NOI to this NOI, there's a lot of work that has happened, an entire year worth of work in order to make that property, perform better.
Right.
And some people don't want to do that heavy lift, don't want to do that heavy work, but they have the money and they're willing to take, less return on their money, meaning they're buying at a higher price, because they are what we called yield investors. They want the cash flow from their property. Someone else has already optimized the property, has already done all of the hard work, and they're just basically cashing in on this NOI every single year without much work, because there's nothing else left to do on the property but, just when rent is due, get the money into the bank account. So does that explain it? Is it a little bit clearer? Is it clear as mud?
Yes.
Or is it clear?
It's clear.
Clear. Okay, awesome. Well, that's pretty much what a cap rate is. And this is how you're going to value a business. For example, when you start looking to buy your gallery that you're looking to buy, they're going to, business brokers are going to be talking about NOI. And they're going to be talking about a multiple of NOI, because that's really what a cap rate is. It's a multiple of the net operating income. And they're going to be telling you, okay, galleries right now in this market, in this area, are selling in this price point, and therefore they're selling at this multiple of NOI. And they're going to be talking to you about that. So that's why I wanted you to understand it, because just like it applies for multifamily, it applies for a business as well.
Right.
Okay? I wanted to finalize one thing, because I wanted to quiz you, make sure that you got it. And that is, so when would you want to buy? Would you want to buy at a high cap rate or at a low cap rate?
You want to buy at a high cap rate.
At a high cap rate. And
which means prices are lower.
Exactly. So because cap rate and prices, have that inverse relationship. And so then at what kind of cap rate would you want to sell then?
A low cap rate.
A low cap rate, which is going to mean a high price.
Right.
Okay. So I think you got it. There we go. I think we're ready to go and start looking at properties, or maybe even start looking at galleries, don't you think?
I'm ready.
You're ready. Okay, first let's finish sophomore year, right?
Yeah.
Yeah. Let's also complete and finish our fundraising campaign for the Lymphoma and Leukemia Society, and maybe in the summer we could start looking at shopping things around. What do you think?
Okay, I'm okay with that.
Okay. In our home, we talk about assets being a girl's best friends, right? And we love the fact that assets can produce income for us and that we're producing that income without having to exchange our for dollars, which is the whole point of being in real estate, is for wealth creation, but also for the freedom that it can afford you, freedom of money, time, relationship, and purpose. If you enjoyed today's episode, give us a 5-star review, subscribe to the podcast, subscribe to the YouTube channel. Thank you so much. And until the next one.